Good day and welcome to our session, Class of Business. We will be discussing Class 7 today, which is the investment component. But before I start with the session, I just want to take you to our website and just explain to you something about our Class 7, as we have broken it up into various product groups that you can order from us. You'll notice on our website that we have already recorded Class 3 long-term insurance and Class 4 pension fund benefits. And as you are aware that we are now recording the Class 7 video as well. If you look at the website, you'll find the products there. Class 1, which is personal line short-term. Class 2, commercial line short-term. Class 3, which is your long-term insurance product, which we've already done a recording for. Class 3.1, which is assistance policy. It forms part of the Class 3, but it deals with funeral policies per se for those that only work in that market. In Class 4, which is your pension fund benefits, that we've already done a recording for. Class 5, short and long-term products, which is mainly done by banks, or clients that work in banks, or if you sell banking products. Structured deposits, which is Class 6. And then investments, Class 7. Now, investment consists of subclasses 7.1 right through to 7.9. Now, because of some of these subclasses are highly technical and more complex products, like derivatives and warrants and options and things, which is more risky products, companies has asked us to split these Class 7 offerings into different groups. So what we've done is we've made a group, basic and collective investments, as one of our larger clients is using this. That covers 7.1, 7.2, 7.4, 7.7, 7.8, and 7.9. Then we've made a separate group, just the advanced investments, which covers these more risky products. That is Class 7.3, 7.5, and 7.6. And then just basic investments, which we are dealing with in this session that I'm sharing now. And then we're going to add another session after this one. So basic investments will then cover classes 7.1, 7.2, 7.4, and 7.9. And then the next grouping that we've put together is just collective investments, as there's some of our clients that only allow the advisors to do collective investments, and they're only registered on their license for this, and that's 7.7 and 7.8. You will eventually, if you do the basic and collective investments, then cover the subclasses for basic and the subclasses for collective investment. And then we've got Class 8, which is your Forex, and then Class 9, which is your health services benefits. So those are the 9 classes of business. We expect in future that the FSCA might add a 10th one, which would possibly be cryptocurrencies, but that's not yet confirmed. Right, so if we look at this specific module that we are going to look at now, which is Introduction to Investment Advice, and here we're going to cover asset classes and basic investments, and we're going to cover subclasses 7.1, 7.2, 7.4, and 7.9. So remember, there's 7.1 straight through to 7.9 if we do the full version of Class 7. So let's just have a look at the content that we'll be covering in this session. It consists of 7 units. Unit 1, we're going to look at, analyze, and describe the different asset classes and their roles in a financial plan. Unit 2, briefly describe financial markets and instruments in terms of investments. Unit 3, we're going to discuss the different types of investment vehicles. Unit 4, analyze the effect of investment environment on the asset classes. Unit 5, investigate how market conditions impact on these asset classes. Unit 6, discuss the composition of investment portion of a financial portfolio with reference to asset classes. And then the final unit we're going to discuss here will be analyze the risk profile of a client in order to propose a financial solution. So it's important that you understand the client's risk and how much risk they're willing to take, whether they are conservative or aggressive in their risk profile, and then give them the appropriate product, which we will be discussing in our session today. Right. If we look at an introduction to class of business, what exactly is class of business? Here is a definition that we've been given. Class of business is an industry classification of insurance products according to the perils insured and the exposure. So today we're dealing with investments, and in this case, basic investments and asset classes. The purpose of classifying the insurance business is to group homogeneous risks for purposes of rate development. Now, the risks usually refer to life cover, disability cover, cover on motor vehicles, on buildings, and so on. So that is what they need to understand, which class is this and what is the rate that they need to charge per, let's say, 10,000 risk. So they need that for what they call rate development. Unlike product training, class of business training includes training on product features, including the typical fee structures and the suitability of different products or features for different types of clients. Class of business training also look at the impact of current events on these products. Current events are not limited to technology, socio-economic, socio-political, and legislative changes. So there could be other things that impact on the growth in a portfolio or the performance of a share, but that is just some of the events that we look at in class of business. Now, Unit 1, we're going to look at analyze and describe the different asset classes and their role in a financial plan. Right, let's just have an overview of asset classes. The four main asset classes or principal investment markets are cash, which is short-term money market accounts, bonds, which is more a long-term money market, property, and then equities, which is your share market, where you'll find these on the JSE, Johannesburg Stock Exchange. The characteristics of asset classes are cash is the safest asset class and provides the lowest return over time. It covers such investments as on-call bank deposits, cash management trusts, and similar short-term interest-bearing instruments. Because cash is the safest investment market, it is used as a benchmark against other investments. When cash rates are low, other investments become more attractive and tend to rise in price. Cash tends to have a low correlation with other asset classes. Right, then we can look at bonds. Bonds are also interest-bearing instruments, but involve a more extended maturity period, usually for some years. Government bonds, local authorities, parastatals, and corporate borrowers borrow money from investors by issuing them a debt instrument, which they call bonds. By holding a bond, an investor is usually entitled to an annual cash interest payment fixed at the purchase time. While this locked-in interest rate may seem safe, it exposes the investor to more risk. If inflation or short-term interest rates go up during the period to maturity, the investor obviously loses out. Bonds are low to medium risk investments and provided low to medium returns, over time. But again, because they are a more safer investment. Then we can look at property as an investment. Property covers the whole ambit of real estate investment, from rural estates to office blocks. It's a medium to high risk asset class with returns proportionate to this risk. Because the property market in generally is adversely affected by rises in interest rates, it tends to have a low correlation with interest-bearing investments, especially cash. Then you can look at equities. They are some of your higher risk, high return categories of investments. Investors take a direct share in profits or losses of a company and hence in the economy itself. If we continue with our overview of asset classes, an essential principle in examining asset classes is that time horizon and inflation have an impact. Although cash and bonds are safer in the short term, they provide less protection against inflation in the longer term. Long-term investments are riskier in terms of maintaining real buying power, while property and equities are safer. Tax considerations generally accentuate these factors. An analysis of South African experience suggests that over time, the four asset classes are likely to produce the following real after inflation returns in the long term. So we see that cash will give you about anything between 0 and 1%. Again, risk is low, but also the performance is low. Bonds between 1 and 3%. Property will give you between 2 and 4%, whereas equities, where there's a higher risk but also a higher return, which will be between 7 to 9%. It does not mean that the typical investor should put all their funds into shares. Such a move would subject the investor to significant short-term risks, and there is no absolute right or wrong class of investment. The investor's time frame and objectives are both critical in the choice of an asset class. So we'll also have to look at the risk profile of the client, and as I said, age and time. How much time does the investor have to leave the money there if the market should go down? Based on Fortune Strategy, the definitive guide by Bradley and Higgins and Abbey, the alternative asset classes would be, and you can also look at derivatives, currency funds, hedge funds, and commodities are some of the other classes. We'll discuss these later on in our session. It is acknowledged that investors should spread their investments between different asset classes to reduce risk and improve their return. The secret is to find an asset class that performs differently from other asset classes. In technical terms, the assets should be uncorrelated. When the price of one asset class is declining, the others should be increasing or at least retaining its value. Gold, for example, is a good hedge against inflation and political uncertainty. In such times, equities and bonds are likely to fall in value, while gold retains or will increase in its value. Traditionally, equities, bonds, cash, and property have been considered the investment classes to which investors should allocate their investments. In recent years, however, investment horizons have broadened. Harvard and Yale universities, which manage considerable endowments, invest in as much more a full spread of investments. Investing in alternative investment aim to find investments whose risks and returns characteristics differ substantially from those of equities or bonds. Generally, such investments have the following characteristics. They are relatively illiquid. It is a major limiting factor when deciding how much money to allocate to alternative investments. They require proper and due diligence investigations because they generally suffer from a lack of transparency. Dealing with them requires a specialized knowledge and ordinarily considered ability. Their performance is often difficult to evaluate because of the difficulty of ascertaining prices regularly. Consequently, before committing funds to such an investment, the investor should carefully consider the following factors: the state of the market for the selected investments, the process by which the managers select investments, the depth and capabilities of the organization managing the investments and the processes they have in place to manage risk, the character and capabilities of these people involved in managing the organization, and the terms and structures relating to the particular investment. It should involve careful study of any documentation accompanying the investment. If we look at asset classes, what are asset classes? An asset class is a group of similar investment vehicles. Different classes or types of investment assets, such as fixed income investments, are grouped based on having a similar financial structure. They are typically traded in the same financial markets and subject to the same rules and regulations. It should be noted that there are arguments about exactly how many different classes of assets there are. Many market analysts and financial advisors argue that futures and other financial derivatives, which is part of advanced investments, can also be viewed as an asset class. Each asset class will perform differently in each market environment and is expected to reflect different risks and returns on the investment characteristics. Asset classes and asset class categories are often mixed. In other words, describing large caps stocks or short-term bond assets is incorrect. These investments are asset class categories and are used for diversification purposes. Stocks or equities. Equities are shares of ownership issued by public traded companies. They are traded on the stock exchange such as the JSE, the New York Stock Exchange, or the NASDAQ, which is an electronic exchange. You can potentially profit from equities either through a rise in the share price or by receiving dividends on your investment. The asset class of the equity is often subdivided by market capitalization into small caps, mid caps, large cap stocks, which they call the top 40. Right, if we look at bonds or other fixed income investments, fixed income investments are investments in debt securities that pay a rate of return in the form of interest. Such investments are generally considered less risky than investing in equities or in other asset classes. If we look at cash or cash equivalents, such as money market funds, the primary advantage of cash or cash equivalent investments is their liquidity. Money held in the form of cash or cash equivalents can easily be accessed at any time. Real estate or other tangible assets. Real estate or any other physical assets are considered an asset class that offers protection against inflation. The tangible nature of such assets also lead to them being considered more of a real asset. In that respect, they differ from assets that exist only in the form of financial instruments, such as derivatives. The characteristics can be determined by evaluating each asset class risk versus return and the volatility attached to each of these asset classes. The characteristics of the asset class are as following. Short-term money market or cash. Most of us can conjure images of the old school stock market with traders shouting and buying and selling prices from the floor, but the money market draws a blank. People can't, think of what is a money market. In simple terms, the money market is where companies, governments, and banks raise money by getting short-term loans from investors. In practical terms, all transactions are now done electronically through a network of buyers and sellers, sometimes in auction run by banks, and there are no central or physical location where the money market exists. Recent events like the collapse of African Bank and global financial crisis in 2008 underline the fact that no investment is without risk. And we also saw this last year with the Russian invasion of Ukraine, when the markets suddenly dipped seriously in April. That was this year. And then they recovered from that again. Because cash is the safest investment market, it is used as a benchmark against other investments. And when cash rates are low, other investments become more attractive and tend to rise in price. When should I use a money market unit trust? A money market unit trust are an excellent tool to use for money in transition or short-term savings or an emergency plan. They are an effective parking place for your money. They allow you to store money that you will use shortly while getting some returns. In some way, a money market fund is comparable in use to a fixed deposit account that you get from a bank with some advantages. You can cash out whenever you want. With most fixed deposit accounts, you are locked in for a specific period where you may not withdraw your money without penalties. Let's say you've got a 6-month or a 12-month deposit account that's fixed, then they'll penalize you if you draw it out earlier. A money market unit trust is more liquid, which is sometimes where you should consider when comparing its returns to a fixed deposit from a bank. Your eggs are not all in one basket. A money market unit trust has investments across lots of insurers or issuers, whereas a deposit is only with a single bank and they guarantee your deposit, but banks do sometimes fail. So although your risk is low, it is also concentrated in that one specific bank. We still remember the run on Sambo Bank, where the bank also collapsed and investors lost their money. And I think one of the other recent examples is the VBS Bank, that there was also a run on the bank and there was also fraud involved and a lot of investors lost their money there. Long-term money or capital markets, like bonds. Capital markets are venues where savings and investments are channeled between the suppliers who have the capital and those who need capital. Entities with capital include retail and institutional investors, while those seeking capital are businesses, governments, and people. Capital markets are composed of primary, newly formed, issued securities are bought or sold in the primary markets, and secondary allow investors to sell securities that they hold or buying existing securities in the markets. The most common capital markets are the stock market and the bond market. These days we use terms bond rather than gilts or semi-gilts. Bonds are interest-bearing investments but involve a more extended period of maturity, usually some years. Right, let's look at gilts. Gilts and semi-gilts operate in the same manner, as the only distinction between them is that a gilt can be described as a government or quasi-government debt instrument, an IOU. Each gilt has a fixed redemption rate when the money will be repaid, interest rate and face value, the price for which the government sold it in the first place. The gilt are sold and redeemed by the issuing authority at their face value, known as par. During this period, the holder receives a fixed rate of interest, let's say 15%. This interest rate is sometimes called the coupon. Gilts are secure because they are government underwritten or underwrites them. Therefore, there is almost no risk that the debt will not be repaid. The current level of interest rate determines the price of the gilt. A gilt paying a fixed interest rate of say 16% becomes more valuable when interest rates fall because institutional buyers cannot get such a high interest rate in the market. They are thus prepared to pay more than the face value for that specific gilt. For example, if the interest rates were set at 16% when Eskom's first sold the gilt and subsequently it declined to, let's say, 15%, and the gilts paying 16% would immediately become more valuable because it is at a higher rate. The price of a gilt moves up until the effective rate becomes into line with the current rate in the market. If you pay, let's say, 1 million for a gilt with a face value, 1,010,000 for a gilt with a face value of 1 million, the effective interest rate will be approximately 0.25 lower than if you had paid the face value. The capital value generally increases by roughly 10,000 with each 0.25% interest rate fall. For this reason, gilt prices move inversely with interest rate levels. In the gilt market, a round lot of 1 million worth of stock at face value. In other words, the minimum quantity that have been bought or sold is 1 million worth. which puts this market way outside the range of most private investors. For this reason, the market also allowed trading gilt options for as little as 2,500 Rand. Right, semi-gilts. Semi-gilts are like gilts with the main difference that they are issued by semi-government institutions, or what they call parastatals, such as Eskom and Transnet, local authorities, for example, your municipalities, and sundry public borrowers, such as your water boards. Right, let's look at bonds. Today, the use of the term gilts, which come from the fact that historically they were printed in gilded borders, is now considered by some to be archaic, and the general term bonds is a more common usage. So when somebody refers to an owing a gilt or a semi-gilt, they owe a government or semi-government bond. You can use bonds to lower your risk or to diversify your portfolio. These used to be called spot bonds. The following bonds are listed on the JSE: your green bonds, your government bonds, your corporate bonds, and your repo bonds. Right, let's have a look at a debenture. A debenture are a type of debt instrument similar to a bond that companies issue in order to raise capital. Details of debentures are documented in an indenture, which is a written agreement between the issuer and the holder. Companies pay investors interest for the term of the debenture. At the end of the lending period, issuing companies usually offer the choice of converting the debenture into shares, physical assets, or collateral. Do not secure debentures. Provide higher rates of financial return than government bonds or bank interest rates. At the end of the lending period, issuing companies usually offer the choice of converting the debenture into shares. These are called convertible debentures and usually pay a lower interest rate to the lender or the investor. The investor is paid to the interest is paid to the investor whether by issuing company makes a profit or a loss. Are transferable from investor to investor. The debt equity ratio, the investor should consider the ratio in which debt is used to finance the projects and capital compared to that is used for equity. If more debt is used to finance the company, the risk of default should be considered. Debentures are unsecured and only backed by the issuing company and their credit worthiness and reputation. The investor is lending money to a business, and a debenture carries all the risks that this involves. A debenture, like a bond, is a loan where an individual lends money to a company to finance specific projects. So the holder of the debenture or the buyer does not take part in the profits or the losses suffered by the company. Like a bond, the description of a debenture has three indicators. Number one is the coupon rate, which indicates the annual interest income per 100 nominal capital value or the face value, the name of the company that issued it, and then the years in which redemption of the capital amount borrowed will take place. Property, there are two types of investing in property. The one is direct property investment. Direct property investment in terms of commonly used to describe real estate investments, whether it is the purchase of a commercial, industrial, retail, bulky goods, residential, or any other property asset which can either be held directly, direct ownership on the title, which means you buy a residential house and you buy some more additional ones that you rent out. So that is a direct property investment. Over the last 2 decades, direct property investments has grown dramatically and has become a core investment class for the growth of wealth through substantial risk-adjusted returns, while also providing a stable source of income through regular distributions of underlying rental income. Then you have your indirect property investment. You can also invest in property indirectly through collective ownership vehicles such as managed property investments like funds, trusts, and or syndications. Property funds, investors in direct property investment funds include those offered by large institutions, public and private companies, and are wholesale and retail investors. Then your other asset class is equities. The term equity has a different definition depending on the context. Let us talk about the definition of equities in the context of the stock market. In simple terms, equities are shares in the ownership of a company. When a company issues bonds, it is taking loans from buyers. When a company offers shares, on the other hand, it is selling partial ownership in the company. People invest in equities because of their potential for high return in your investing portfolio. Your equity exposure is another way of describing your exposure to the risk that you will lose money when the value of the stock you own declines. Conventional wisdom states that young people can afford more equity exposure and therefore will likely want more stocks in their portfolio because of their potential return over time. As you are planning to retire, equity exposure becomes more of a risk, which is why many people transitioning at least part of the investment from stocks to bonds as they get older to reduce their risk, obviously. Then you get different types of shares. You get ordinary shares and you get preference shares. Ordinary shares are the most common type of share traded on the JSE equity market. Ordinary shares give you the full voting rights at annual general meetings, dividends should the company pay these, and a share of the residual economic value should the company unwind. After bondholders and preference shareholders are paid, they are also allowed you to benefit from capital growth should the company do well. Your preference share, companies issue preference shares to raise capital. Preference shares carry many of the benefits of both debt and equity capital and are hybrid security. A benefit for investors who hold preference shares is that they receive dividend payments before common stockholders or shareholders get. A drawback is that they have no voting rights as common shareholders typically do. Then you get cumulative preference shares. The dividend is accumulated if the company does not earn sufficient profits to pay the dividend. If the dividend is not paid in 1 year, it will be carried forward to the successive years. Then you get non-cumulative preference shares. If the company is unable to pay the dividend on preference shares because it's insufficient profits, the dividend is not accumulated. Preference shares are cumulative unless expressly stated otherwise. And then you get participating preference shares. A participating preference share, in addition to the fixed dividend share in the profits of a company at a specific rate. Then you get redeemable preference shares. A redeemable preference share can be redeemed at the option of the company, either at a fixed rate on a specific date or over a specific or certain period. Then you get irredeemable preference shares. Such shares cannot be redeemed during the lifetime of the company, but can only be obtained at the time of winding up or liquidation of assets. And then you get convertible preference shares. Apart from earning a fixed dividend, convertible preference shares can be converted into ordinary shares on a specific terms. Then deferred shares. A deferred share is a share that does not have any rights to assets of a company undergoing bankruptcy until all common and preferred shareholders are paid. It may also be a share that is issued to company founders that restricts their receipt of dividends until dividends have been distributed to other classes of shareholders. Deferred shares can also be awarded to venture capital and other private investor groups as part of long-term investments in a company. Then debentures. In corporate finance, a debenture is a medium to long-term debt instrument used by large companies to borrow money at a fixed rate of interest. Debentures are generally freely transferable by the debenture holder. Then other asset classes like rare coins, gemstones, and Kruger rands. Rare coins, the market of rare numismatic coins is much tougher to quantify as it covers such a wide variety of coins within that term. These types of coins should probably be viewed as a niche investment strategy. And if you are looking for high growth strategy involving rare coins, it is probably the rare bullion coins which will give you the less sleepless nights. Gemstones, they are aesthetically appealing, rare, durable, and of high quality. These characteristics distinguish them from minerals. Krugerrands, physical gold coins is full, half, or quarter of it, or a tenth size. Bullion in rare coins are generally considered to be one of the safest investments on the market. And this is where the overall perception of a rare coin market comes from. So you need to understand the difference from a rare coin investing if you have already not made, if we haven't made this point clear. Right, then future contracts. A future contract is a contract between two parties where both parties agree to buy and sell a particular asset for a specific quantity and at a predetermined price at a specific date in future. And then shipping containers, another asset class. A shipping container is a container with strength suitable to withstand shipment, storage, and handling. Shipping containers range from large reusable steel boxes used for intermodal shipment to the unambiguous corrugated boxes. In the context of international shipping trade, containers or shipping containers is virtually synonymous with intermodal freight containers, a container designed to be moved from one mode of transport to another without unloading or reloading the content of the container. Right, that concludes this session, which is Unit 1, Analyze and Describe the different asset classes and their roles in a financial plan. I will then see you in the next unit where we will discuss briefly by describing the financial markets and instruments and the terms of investments. Thank you for attending this session. Then we'll restart in Unit 2, the next session. See you there.